Hey guys, it's Kristen Torres, your favorite financial plug. I'm just out of Nashville, Tennessee. And if you've been following my channel, you know that I'm going to be the one to actually put you on to some game. So today I want to talk to you guys about what is being left out of information that you've been seeking when it comes to your finances, where you're even putting your money, where it's sitting, where it's growing. And so I want to explain to you that there's a tier system, there's a level system of power that you might not know actually exist. After learning about these levels of power, it's going to give you some more insight on where you should be keeping your money, especially in times like this. So, I'm going to actually draw this out for you guys. And if you have any questions, definitely please leave the comments in the comment section. I would love for you to do that so that I can answer any questions that you have. This is somewhat of a complex type of strategy or explanation of what's going on, but I'm going to do my very best to make this as simple as possible. All right. So let's talk about the hierarchy system of money. All right. So we all know that when we get paid, that our money typically is put into where? Into the bank. Okay. Whether it's direct deposit or you cash a check, most of us typically use banks. All right. Now, I always ask this question, and a lot of people they give me a kind of like a mixed bag of nuts kind of answer. I say, "Why do you use banks?" And they always say, "Well, I use a bank because that's just the only place I know where to put money, or I use a bank because I feel like it's safe." I rarely hear anyone say that they use a bank because they feel like they're going to make any money at the bank. But typically, it's usually something towards convenience or safety. Now, a lot of people when you've walked into a bank, which I know a lot of us don't walk into a bank too much anymore, but you've seen these letters or you just know about them. FDIC. Now, when I ask people what does FDIC stand for, they typically do not really know. They know the first word is federal. The feds definitely make sure we know that that F means federal, but it stands for Federal Deposit Insurance Corporation. Now, let's think about this for a second. We put our money into banks because we feel like it's safe, and the Federal Deposit Insurance Corporation does insure our money up to $250,000. Now, what people don't know is just because something happens and your money's insured up to $250,000 does not mean the bank is going to pay that back immediately. All right. A lot of that money that banks say they have, they actually don't have. All right. And I'll go into that in a second. But FDIC, Federal Deposit Insurance Corporation, the I stands for insurance. All right. So what does that mean? It means that banks are actually backed up by insurance companies. Now, if you think about it, we insure everything, right? Insurable insurance companies are some of the most credible companies out there. We insure cars, homes, people, pets, body parts, cell phones, TVs. I just listed so much that we insure, so many things. Now, in my 40 years of living, guys, I might have had one slim little insurance check, I think, from a car wreck. It covered pretty much nothing. So I think about all the money that I've sent to insurance companies over my lifetime, right? And if you're older than me, you can only imagine how much you've paid into insurance on those different things that I just listed. A lot of us have not seen an actual, refund or some type of monetary check or something like that back from an insurance company. It's just something that we have to pay for to make sure that we are prepared if something happens. Okay. So if you think about it, insurance companies are actually some of the richest companies in our country. No, you're thinking, yeah, that actually makes sense. I also want to point out that I did not draw these rectangles, although I'm not the best artist in the world. I did not draw them by accident in this order. Okay, I'm giving you a hierarchy, a system. There's us, there's banks, and then at the top, there's insurance companies. And like I said, they control and have a lot of the money that circulates around in the world. So let's talk about this for a second. Now, banks, what do? told you that banks usually don't even have what they say they have, right? A lot of that currency kind of doesn't exist in a way. But banks are always trying to make money. They're flipping your money. When you put your money in a bank, they're going to go make money off of it. Unfortunately, they do not give you a whole lot of that back. But the ratio in which banks operate on is what we call a 1 to 10 ratio. So that basically means that for every $1 million a bank has, they loan out an entire $10 million. Yes, what I just said is correct. For every $1 million a bank has, they loan out 10 million. So a lot of that currency, like I said, is them out there trying to make money off of your money, not necessarily saying that they actually have that money. So again, why they need insurance? Because insurance companies are going to back them up in the case where they don't have it, right? So insurance companies, on the other hand, they run on an opposite ratio of 10 to 1. So for every $10 million an insurance company has, they're only going to loan out 1 million. Hmm. Now your rules are turning even more because that's a safer ratio in which to operate your business on, isn't it? So you have a lot more money than banks. They come to you for insurance when they don't have it. And for every $10 million that you have, you only loan out one. Man, that's pretty smart and safe. All right, but let's take this a step further because, like I told you, there's something that they're not telling you, even outside of what I just went over already. You think about it, since 2008, and there were a lot of fireworks going on in 2008, bad fireworks, not good, right? But since 2008, over 300 banks have gone out of business. And I know a lot of you were tuning into the news even last year, and you're like, what is going on? How does a bank go out of business? Well, I just explained to you why. And so over 300 have gone out of business since the year 2008. Now, can you guess how many insurance companies have gone out of business? And there's two answers to this because I'll say technically one, right? There was a company that did get a little bit in trouble, a little hot water. They did have to take some assistance, but they're still around and kicking. So honestly, without that technicality, right, the answer is zero. Okay. But some people say, well, actually, Kristen, it's one. So regardless, if you go with the answer of zero or one, right, it's way lower than how many banks have gone out of business. And the reason being because insurance companies have a ton of money, right? And the ratio in which they operate is definitely a way safer ratio than banks, right? So let's put this all together because this is where I'm going to really connect some dots for you. Now, as you can see, we see the hierarchy of money. And, you ask yourself, or actually, you know what? I remember my mom always said, hey, if you don't ask, then you definitely not going to get it. Right. So a lot of people say, question, is there a way for me to kind of bypass this whole middleman, which is the bank? And it seems like insurance companies are a lot more safer. So is there a way where I can just do transactions with insurance companies? Well, the answer is actually yes, you can. Okay. Now, this concept has a lot of different names, and I've heard them. And honestly, I might just coin my own concept because I feel like they're not all encompassing of what you can definitely benefit from when you do this. Now, of course, you're sitting here with your eyebrow raised and you say, well, Kristen, if I bypass the bank, how am I going to pay my bills? Or, what if I need to access money very quickly, want to go to the ATM, right? I'm not saying that you don't use banks, okay? But think about it. If a bank is only going to give you 0 to 1% on your money, oh, and by the way, don't forget that you got to pay taxes on what you do earn, even if it's not a lot. So, and you're taxed on that, right? Anything outside of like a checking account to pay your bills or, a little small immediate emergency fund that you can use for something that happens like a tire or something small like that. Yeah, definitely use the bank because really it's just there for convenience. That's pretty much it. You're not growing anything. And by the way, guys, this is the kicker. This is honestly the reason why I wanted to do this video. Okay. So lean in, pay attention. But here's the thing about banks. We have certain things that happen, such as, creditors calling you, saying you owe money, debtors, garnishments, right? Increase in taxes. These are all things that we have no control over. And a little short story, I remember when I was 21 years old And it was actually a mistake, but one of my student loan bills was going to another address. I moved around a lot. And so I was missing the bills, and I honestly didn't know how to log in and actually look at my bill to take care of it. So it went unpaid for like maybe 3 or 4 months. Finally, I get a call, and I guess they were able to reach me on my phone and not, through email or another address. I'm not sure why. But the lady was threatening me on the other line, saying, "Hey, we're going to garnish your wages. You have not paid your student loan uh, payments." And I remember thinking, or first thing I said was, "Lady, I've been trying to figure out who you guys are and who I owe. I never got anything in the mail." That was the first thing. But even through her threats, she kept saying, "I'm going to garnish your wages." And I remember at 21 years old saying, "What does that mean?" She said, "Oh, we can legally go into your bank account and pull this $986 a month payment." Of course, my jaw drops because at 21 years old, I need that $986 to pay my rent, right? And guess what? They did it for a couple months until I went to court and got everything fixed. But I remember that feeling of having someone who was not me reach into my bank account and take my money. And let me tell you, I worked hard. I was just out of school. I was a respiratory therapist, and I was working night shift at one hospital and day shift at another hospital. I mean, your girl was really working. And so that crushed me as a 21-year-old, knowing that someone could reach into my bank account and take my money. So think about it. When your money's sitting in a bank, who has access to that? Well, the bank has access to that money, correct? Yep. So the good old bank has access to that money. Who else? Well, the government can definitely reach in there. Okay, so we got the government. They can reach in there and take if they say that you owe them. Okay. Other creditors, debtors, right? I'll just say C and D. They can reach in there and take money. All right. And then also when taxes increase, and let's say you get on the bad list on that, okay, that's also a way where not only are you losing to increasing taxes, so you're paying more because taxes increase and you have nothing to do about that. But then also, if you owe them, right, they can also access your bank account. So this to me, and like I said, this was 21 years old starting to learn about this, but this to me was a red flag because I want to know that I have total control over my money. I made the money. I want to be able to say, "Hey, I know I owe you, or I know I got to take care of this, but let me figure out how I'm going to do it." This right here, this middle part of this screen that you're looking at, in a way, like I said, this is a way where you have no control over what you have as far as what you are carrying in your bank account and whatever else is going on or whatever other entity can reach in there. So, this is why I want to do this video, guys, because you are very vulnerable when you're stuck in the middle of this screen. How do you bypass that? Now, here's one thing that people don't know, and I know that tax codes are not fun, kind of boring to talk about, but you need to know two tax codes off top. First one I want to teach you guys about is IRC 72E. Okay. And then the other one is IRC 7702. Specifically, we're talking about Section A. Now, these two tax codes will allow you, okay, to actually have an account with insurance companies. So we're used to having an account at a bank, right, or a credit union, but these will allow you to have an account with an insurance company. And as you can see now, you're at the top of this whole entire structure and you see how safe it is, okay? And then also on top of that, insurance companies have a ton of money. Okay, we went over that in the beginning. So you're thinking, I want to actually be a part of this party. Yeah, I have a bank account where, I have some money that goes in to pay my bills. Great. And I got a small little emergency fund. Great. But I know that if I keep the majority of my money in a bank, there are other entities that can reach in there and take my money. Okay. So yes, you can have a smaller account, but for the rest of your money, you can actually bypass the bank. We call it cutting out the middleman. All right. And so once your money is with insurance companies and by IRC 72E and IRC 7702 Section A, you are able to have an account with insurance companies. This gives you protection. You are protected from increased taxes. You're protected from the government, the IRS. You're protected from creditors and debtors. You're protected from everything, divorce, you name it, bankruptcy. these tax codes will not let anything get into your money. Okay. Now, people say, man, I did not know that you can have an account with insurance companies. Well, let me let you know something. You probably did know. It was just called something that you didn't realize that's exactly what it was. And what is that term? Cash value. So now you're thinking, aha, I have heard of cash value. I know exactly what she's talking about. And I had no clue that basically that's the equivalent of an account. Yes, it is. So now you have an account with insurance companies. Your money is protected from all the entities that are not protected when your money's sitting in a bank, right? With 72E and 7702A. But also, you have some other perks that come with this as well. One of those being you get to choose how the money grows in this account. Now, typically with banks, especially your savings accounts and your checking accounts, they're going to give you the option to have a fixed account, right? Sometimes you have the option, or there's choices where you can choose variable, which means you are dealing directly in the market when you're growing money. But they do not offer, I'll say banks do not offer the third way that money can grow, which is called indexing. So when I say indexing, I'm more or less talking about index accounts. Okay. I'm not talking about index funds. Now, with cash value, like I said, you have three choices on how you want to grow your money. First is fixed. Okay, so fixed means they're going to give you a fixed rate. You already know what that rate is. It's usually not very high. Next one is variable. Okay, so that's anything directly in the market, right? So a lot of people are familiar with variable accounts when they mention mutual funds and stocks, things like that. But the last option is what we call indexed or indexing. Okay. So those are the three options that you have to grow your money in your cash value account with insurance companies with the protection from all the entities listed below, right? So on top of the protection, you get to choose how you want your money to grow. Now, I'm going to erase this so we can go over those three ways money can grow real quick so that you have an idea of why you're picking what you're picking. So first, like I said, is fixed. That's like when they put your money, like I said, in a bank or whatever bank account. Let's say they give you 1% at the bank, which honestly, I don't even get a full 1% at my bank. But if you are, I'd like to know who you bank with. There are some other accounts where you can get a little higher of a fixed rate, but right now those are kind of going down as well. So I know a lot of people like to reach for CDs, things like that. But definitely check on those rates because they do change and fluctuate after their contract time is up. Okay, so fixed. Next, we have variable, and it pretty much looks like that, right? So if you ever just log into your retirement savings plan at work and you say, oh my gosh, okay, I shouldn't have logged in. Maybe I should have waited, right? So we know that when the market goes up and down and up and down, you're constantly gaining and losing money. Now, I know I did another video where I told you about actual versus average return. Okay. And so a lot of us are stuck to believe that, hey, if the market went down 50%, but then went back up 50%, I'm back where I started. And we also know that that's not exactly the truth. That is called average return. But when you're talking about actual return says, hey, if you had $1,000 here and the market went down 50%, well, you're down to $500. Okay. But when it goes up 50%, you're thinking you're going to be back at 1,000. No, 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 no. You're only going to get a 50% gain off this 500, which is what? 250. So 250 plus 500 is 750. So not necessarily are you recovered, even though the market recovered. And that is what we call actual return. Now, on to the third, indexing, right? So I'm telling you in this cash value account, you get to choose how the money grows. In indexing, okay, I'm going to do the same thing. You're like, well, Kristen, how's this any different? It looks like what you just did. Well, hold on a second. This is actually what indexing looks like. So what you're doing is you're getting to capitalize on the gains of the market. But when the market goes down, you plateau and you keep whatever you gained from that last time that you actually were positive with that indice. Okay. So that strategy. So essentially, they are taking away the risk and only allowing you to gain money. Now, scratching your head or raising your eyebrow again, you say, well, hold on a second. My bank doesn't do that. Of course it doesn't. This is insurance companies that offer this strategy of this actual index where you get to capitalize on the gains and not have to take the loss. Again, think about it. Insurance companies have a ton of money. Their portfolios are pristine. They're amazing, right? You see, they run on a 10-to-1 ratio. So they can say they have the power to say, hey, you know what? Bring your money over here. Hey, involve it in what we're doing. We're going to make some money. Everybody makes money. Everybody wins. We'll even assume the risk. We'll take the risk for you, just for you bringing more money over here so that we can grow more money. All right. So it's a win-win for everyone. And the win for you is you do not have to go down with the market. You only gain. So as I said before, you have these three options with your cash value account. And usually I'll ask a client, hey, which option, right, would you like to take advantage of? A lot of times I'll have clients say, well, you know what, Kristen, my entire life I've taken advantage of a fixed option and it hasn't got me very far because per the rule of 72, or what we say, the rule of compound interest, thank you, Albert Einstein, if you take the number 72 and you divide it by the interest rate that you're being given, that equals how many years it takes for your money to double. So at 1%, it would take your money 72 years to double, guys. That's crazy. So they say, I've been doing this my whole life. I don't think I want to keep doing this. All right. So, by the way, this is a tidbit of information for you guys. But for the most part, I'm speaking in general. If you do choose this option for your cash value accounts, this is what we know today as whole life cash value. Okay. Now, if they say, yeah, I've been doing that variable thing as well. I have a retirement savings plan at my job. This is how we grow our money. It's directly in the market, or I have stocks, I have my Robinhood app, whatever it is, right? And they say, but man, I've been doing this my whole life too. And I'm just really trying to like find a way to just, get to the point where I can just grow money and not have to worry about losing it. All right. Well, that's variable. And in the insurance world, if you choose for your cash value account to grow variable, this is what we call variable universal life. Okay. So you're like, oh, I've heard of that before. Yeah. Because you chose for your cash value to grow variable. Now, lastly, you say, you know what, this indexing thing, I've never even heard of this, let alone taken advantage of the fact that I can have an insurance company assume the risk for me and I get the gains. I'm not directly in the market, I'm just mirroring it and they're giving me those gains without the losses. I really like that. And I really want to be diversified. And I don't want to just only have fixed or variable, but I also want to have some indexing going on. So, of course, in the life insurance world, your cash value account that you're growing in that, what type of insurance, when you want your cash value account to grow indexed, that's called indexed universal life. So there you go. That's the difference between the three, is essentially how you choose to grow that cash value account. Now that you have an idea of how you would want to grow that cash value account, right? You looked at the three different ways, fixed, variable, index, and you're thinking, you know what? I'm starting to put a lot of these dots together because if I do choose a way to grow my money where I only get the gains from the market, I do not have to experience any loss, and this money is in a cash value account and is protected because of IRC 72E and 7702A, which allows me to grow the money tax free and take it out tax free. Man, this really seems like a very safe way to go ahead and grow some money very efficiently, but also protect the money efficiently. So you're getting growth and protection when you allow yourself to have an account with insurance companies, AKA cash value accounts, right? And you choose how you want that cash value account to grow. Remember, guys, if you're finding any value in this information, please like and subscribe to my channel. So essentially, what have you done? Well, you've built a bunker for your money. It's almost like Fort Knox. So now you have a place to put your money where only you have access to this money, no one else. You are protected from all the elements that could occur to your money that typically happen in a situation such as a bank account. Like I said, IRS and taxes, right? Anything the government's going to do, garnishments, creditors and debtors, all right? Increase in taxes, market loss, and bankruptcy. And honestly, anything else you can think of that would ruin your financial life. So, because you have this covering around your money, nothing can happen to it. And like I said, that is because of IRC 72E, which allows you to grow it tax free and take it out tax free, with 7702A. Okay, so allows you to grow your money tax free with 72E and take it out tax free with 7702A. Now, of course, you do want to make sure that whoever is structuring this type of account, right, it does take a lot of skill. It does take for you to structure these properly, all right? Because the other part to it is, guess what? Since you are getting this account with insurance companies, what do you need to have? Insurance. All right. So that's how you get into the club. Once you have insurance with that insurance company and you're using the appropriate product to be able to have this cash value account and you chose the way you want that money to grow, well, now you actually have to be approved for the insurance part of this. Okay. So then a part of your money goes to actually paying the insurance policy. And then the rest goes to your cash value account. So here's your cost of insurance, cash value account. So for instance, if you're putting in a total of $500 a month into this cash value account or this insurance policy, and let's say that the insurance costs $100 to carry it so that you can have access to the tax codes 72E and 7702A to get the protection from everything I just listed before. Well, then after that $100 is paid, the rest will go over here. And that is how it works. So, if you have any questions about insurance cash value accounts, how they work, or even if it's something that's appropriate for you to add, definitely reach out. I will leave my appointment link in the comment section. I would love to hear from you. If you have any questions or comments, you can definitely leave them on this video as well. Thank you for visiting my channel.